Hello, welcome to the study of GDP using the income approach. Revisiting the circular flow of income, if you can remember, GDP can be calculated in three ways. That is, the product approach, the income approach, and the expenditure approach. Since we have already studied the product approach, let's look at the income approach now. A note to remember, GDP calculated in the three methods should give you the same result. GDP using the income approach is to add all the factor incomes. Simply put, factor incomes is the addition of rent, wages, interest and profit, which is the same as the addition of employee compensation, rental income, net interest income, corporate profits, and self-employment income or mixed income. Let's look at these in more detail now. Employee compensation is the earnings from supplying labor. This is classified into wages and salaries, payment for social protection, insurance facilities, health facilities, and labor compensation. Rental incomes is the income gained by renting real assets and natural resources. So this includes rental income earned by renting fixed assets and natural resources, rental income earned by renting houses, and the assumed rent for the houses where the owner lives, and the income for intellectual property. The interest income is the payment made by the business sector for the suppliers of financial capital on behalf of the usage of financial capital. Now let us look at corporate profits. Corporate profits are the profits of the owners of business firms registered as companies. It consists of corporate taxes, dividends for owners, and retained profits. Self-employment income or mixed income is the income of sole enterprises not registered as companies, joint ventures, cooperatives, farmers, and incomes of professionals. So according to SNA 2008, Sri Lanka records gross domestic income as follows. Compensation of employees, operational surplus, mixed income, and other taxes on products. Other taxes on products is the taxes imposed over the provision of administration services. It doesn't include indirect taxes. Let's have a closer look at operational surplus. It is the income generated by the corporate sector. Operational surplus is net operational surplus plus fixed capital consumption or depreciation. So net operational surplus is gross operational surplus minus depreciation. Gross operational surplus is the property income earned in the form of interest, rent, and gross profit. Let's look at an example and see how we can calculate GDP at market price using the income method. Let's first calculate the gross value added at basic price. The gross value at basic price would be compensation of employees, net operational surplus, fixed capital consumption, mixed income, and other taxes on products. The answer would be 10,100. Let's now calculate the GDP at market price. So the GDP at market price would be gross value added at basic price plus net taxes on products minus subsidies. This is the same step that we observe when we calculate GDP using the product method. So to get the GDP at market price, we get the GBA at basic price and add the net taxes on products. So eventually, whether you calculate GDP using the product approach or the income approach, you should get the same result. Stay tuned for more concepts on the income approach. Bye.